Have you heard of the short-term rental loophole where investors buy an Airbnb property, create large tax losses, and write it off against their regular income? Well, the IRS is catching on and now auditing many of these investors. And in this video, I'm going to tell you three arguments that the IRS is making and how you can defend yourself against them. We've been getting calls recently to come in and help investors defend themselves in an IRS audit. And what's been surprising is that the IRS agents don't actually know how the short-term rental loophole works. So here are the three erroneous arguments that the IRS agents are making during these audits and the citations that you need to defend yourself and make the IRS go away. The first bad argument that the IRS agents are making is that you have to qualify as a real estate professional in order to use your losses from your short-term rentals. Almost every audit that we see starts with the IRS agent making this argument, but real estate professional status only applies to rental activities. So your defense to this is Reg Section 1469-1TE32A, which says that if your average period of customer use is less than or equal to 7 days, you do not have a rental activity. Just make sure that you have your Airbnb or VRBO calendar ready to prove that the average period of customer use was less than or equal to 7 days. The second bad argument that the IRS is making is that if you don't have a rental activity, per argument number one, then you have to report your short-term rental on Schedule C rather than Schedule E, where it's now subject to self-employment taxes. And your defense to this one is Section 1402A1, which says that rental income is not subject to self-employment taxes unless you are a real estate dealer. Additionally, CCA 2021-51005 says whether an activity is a rental activity under Section 469 is not determinative of whether the exclusion in Section 1402 applies. In effect, what this means is just because you don't have a rental activity under one code section does not automatically make it subject to self-employment taxes and require a Schedule C filing. And before I give you the third bad IRS argument, just a quick mention that you should never go through an IRS audit by yourself or with bad representation. There are many social media gurus that hawk the short-term rental loophole, but they truly have no idea how to implement it or defend you in an audit. So shameless plug, if you're a real estate investor and you need some help with your real estate tax strategy or you're going through an IRS audit, hit my link in the bio. Let's get a consultation scheduled. The third bad IRS argument is that you cannot combine spouse time for material participation purposes. The short-term rental loophole is all about materially participating in the activity so that you can make it non-passive and then offset your regular income. But in a recent audit, we saw an IRS agent make the claim that you have to hit 500 hours in the short-term rental activity and you cannot combine your spouse's time in tracking towards that 500-hour goal. Now, your defense to this is Reg Section 1469-5TA1, which is the actual 500-hour rule, and it includes the term individual. So what exactly does an individual mean? We find in Reg Section 1469-5TF3 that any participation of such person's spouse shall be treated as participation of such person. In addition, Section 469H5 says, in determining whether a taxpayer materially participates, the participation of the spouse of the taxpayer shall be taken into account. So in the context of a married couple trying to materially participate in a short-term rental, the term individual actually means both spouses combined, which certainly makes it easier on you to materially participate in your short-term rental activity and take advantage of this awesome tax strategy.